Mark this date on your calendar right now, because in just a few weeks, the United States government is going to flood this economy with more freshly created money than almost anyone alive has ever seen at one time. And I can tell you, having studied 500 years of economic history, that almost nobody is positioned for what happens next. This is not a guess. This is not a headline. This is how the machine works. And I have watched this exact mechanism play out again and again in country after country for my entire career. When a government owes more than it can ever realistically pay back through taxes alone, there are only a few paths left. And one of those paths is to print the money and buy the debt itself. That is exactly what is about to happen in size and soon. Most people will feel it in their grocery bill and their rent long before they understand why. I'm going to walk you through exactly what is coming, why Trump's own trades are quietly telling you the real story, and what you need to do before this hits your bank account. Before I go further, I need you to do one thing for me, because what I am about to explain is worth more than anything you would pay a financial advisor, and I am giving it to you for free. If you are not subscribed yet, subscribe right now while you are thinking about it, because I am going to walk through the mechanics step by step. And if you miss the middle of this, you will miss the part that actually protects your money. Let me start with something simple, because this is really not complicated once you see it clearly. A country is a lot like a household or a business. It earns money, it spends money, and sometimes it borrows to cover the difference. For most of my life, the United States borrowed in a fairly normal way. It sold bonds. Investors around the world bought them because they trusted America, and everybody moved on. But debt does not just sit there quietly. It compounds. And when you have spent decades borrowing more than you earn, eventually you reach a point where just paying the interest on what you already owe becomes one of the largest expenses in the entire budget. That is where the United States is right now. The interest bill alone is larger than the entire defense budget. Let that sink in for a second. We are now paying more just to service old debt than we spend protecting the country. When a government reaches that point, it has a decision to make, and history shows us it is almost never a hard decision for them, because the alternative options are far more painful politically. Option one is to raise taxes dramatically. Nobody wants to do that, especially not right before elections. Option two is to slash spending on things people depend on. Also politically painful. Option three, and this is the one they almost always choose, is to have the central bank or the Treasury create new money and use it to buy up the government's own debt. This keeps the government funded, keeps interest rates from spiking out of control, and lets politicians avoid the hard conversations. But it comes at a cost, and that cost gets passed quietly on to you, the saver, the person with cash sitting in a checking account, because every new dollar created makes the dollars you already have worth a little bit less. I know some of you are going to say, Ray, I have heard people warn about this exact thing for 15 years and nothing ever happened. So why should this time be different? That is a fair question, and I want to answer it honestly instead of just telling you what you want to hear. You are right that the dollar has not collapsed. And I'm not standing here telling you it will collapse now either. What I am telling you is something much more precise and much more useful than a doomsday prediction. These debt-driven money creation cycles do not destroy a currency overnight. They erode it in stages. A few percentage points of purchasing power here, a few there, compounding quietly over years, the same way a small leak in a boat does not sink you immediately, but it absolutely will sink you eventually if nobody bails the water out. The people who lost the most in the 1970s were not the ones who believed the dollar would hit zero. They were the ones who assumed nothing was changing at all, kept everything exactly the way it had always been, and woke up a decade later realizing their savings bought half of what they used to. That is the risk I am pointing at, not collapse, erosion. And erosion is actually more dangerous in some ways because it never feels urgent enough to act on until it is already too late. Now, here is where it gets specific to what is happening right now. For the last couple of years, the Treasury and the Federal Reserve have actually been doing the opposite of printing. They have been shrinking their balance sheet, letting bonds mature without replacing them, trying to drain some of the extra money that got pumped into the system after the pandemic. That process has a name, quantitative tightening, but you do not need to remember the name. All you need to understand is that money has been getting scarcer, not more abundant. And that scarcity has been one of the quiet reasons markets have felt tight and borrowing has felt expensive. But that phase is ending. The signals are already there if you know where to look. Treasury officials have been talking openly about needing to manage a wall of debt that is coming due, hundreds of billions of dollars that need to be refinanced in a short window. When you have that much debt maturing at once and not enough natural buyers lining up to absorb it at reasonable interest rates, the government does not just sit back and hope for the best. It steps in as the buyer of last resort. It starts buying back its own debt with newly created reserves. That is the flood I am talking about. It is not a metaphor. It is a mechanical, almost automatic response to a debt problem that has been building for years. And it is scheduled to begin in the very near future, right around the date I mentioned at the start of this video. I want you to understand why this matters so much more than people realize, because on the surface, it sounds almost boring, like some technical adjustment happening deep inside the plumbing of the financial system. But I have studied enough of these cycles across enough countries to tell you the plumbing always eventually shows up in your kitchen. When new money gets created and pushed into the financial system, it does not stay contained in bond markets. It flows outward. It pushes up the prices of stocks, real estate, gold, and other hard assets because investors holding cash look around and realize that cash is about to buy less. So they rush to convert it into anything that holds value. Meanwhile, the price of everyday goods, the things you actually need, groceries, rent, insurance, they start climbing too, just usually with a lag of a few months. So what you get is a strange and uncomfortable split. Asset prices, the stock portfolios, and the real estate values, they can look fantastic on paper. But if you are someone who does not own a lot of stocks or property, if your savings are mostly sitting in cash or a basic savings account, you experience the exact opposite of wealth. You experience your money quietly, buying less every single month while watching other people's portfolios grow. This is exactly the kind of wealth gap I wrote about years ago, and it is not an accident. It is the direct, predictable consequence of how these debt cycles resolve themselves. I want to be very clear about something, because I do not want you walking away from this thinking I am telling you the sky is falling. I am not. Economies go through these cycles the way seasons change, and understanding the season you are in is far more useful than being afraid of it. Right now, based on everything I track, debt levels relative to income, interest costs relative to government revenue, the willingness of foreign buyers to keep absorbing new debt at current rates, we are late in a long-term debt cycle. That does not mean tomorrow brings disaster. It means the tools available to policymakers are narrowing, and the tool they keep reaching for again and again is money creation. Once you see that pattern clearly, you stop being surprised every time it happens again, and you start planning around it instead of reacting to it after the fact. Now let's talk about something that I think is being badly misread by almost everyone covering this story, and it involves Trump personally. Over the past stretch of time, he has filed disclosure after disclosure showing an unusually large amount of personal trading activity, hundreds of transactions. Now, people love to turn this into a political argument, arguing about whether it is appropriate or not, and honestly, that is not really my department. What interests me, as someone who has spent decades reading what smart, informed people do with their own money rather than what they say in public, is the pattern underneath those trades. When someone with access to the kind of information a sitting president has starts moving money in a particular direction, that tells you something. It tells you where confidence is being placed quietly away from the cameras. I am not going to sit here and tell you to copy any individual person's portfolio, because that is not how this works, and it never should be how you invest. But I will tell you this: when people with the most access to information start positioning defensively into hard assets and productive businesses rather than sitting in cash, it is usually because they understand on some level that the value of cash is about to come under pressure. That is not insider knowledge in some illegal sense. It is simply pattern recognition. The same pattern recognition I built an entire career on. And right now, that pattern is flashing the same signal it has flashed before. Every major liquidity injection I have lived through since the 1970s. Think about it from a purely practical standpoint, setting politics aside entirely, because I genuinely want to set politics aside here. If you personally knew that a large new supply of dollars was about to enter the system, dollars that would need somewhere to go, would you rather be holding a pile of cash that new dollars are about to dilute, or would you rather already own the kinds of things that new dollars typically chase? Hard assets, ownership stakes in real businesses, productive property. That is not a partisan question. That is simple arithmetic. And when the disclosures show a pattern of activity leaning in a particular direction at a particular moment, informed observers take note, not because it is some secret code to decipher, but because it is one more data point confirming a mechanical story that was already visible in the debt numbers themselves. Let me take you back for a moment, because I think a little bit of history here really helps this make sense. And it is not there just to fill time. It genuinely changes how you should think about your own decisions. In the 1970s, the United States went through a period where the government spent heavily. The dollar came off the gold standard, and the money supply expanded rapidly. Inflation ran wild for years. People who kept their savings in cash or simple bank accounts lost enormous purchasing power, even though the number in their account never went down. People who owned hard assets, gold, real estate, productive companies, they came through that period in a completely different financial position. I lived through that as a young man on Wall Street, and it fundamentally shaped how I think about money for the rest of my life. I remember watching people who had worked their entire lives, who had done everything right by conventional standards, saved diligently, avoided unnecessary debt, kept their money in the bank, and still ended up feeling like they had quietly fallen behind simply because the ground had shifted underneath them without asking their permission. That experience is a big part of why I have spent my whole career trying to understand these cycles rather than just reacting to headlines about them after the fact. Then again, in 2008, when the financial system nearly collapsed, the Federal Reserve created enormous amounts of new money to stabilize the system. Same pattern. Asset prices eventually soared, and then in 2020, during the pandemic, it happened again on an even larger scale, and we watched real estate and stocks surge while regular workers dealt with rising prices for years afterward. Each time, the pattern rhymes. Each time, the people who understood the mechanics protected themselves early, and the people who waited for the evening news to explain it to them found out only after the damage to their purchasing power was already done. What is coming now is not a new invention. It is the same old machine, running the same old program, just with a different date on the calendar. So let's get practical, because I do not believe in scaring people without giving them something useful to actually do with the information. The first thing I want you to internalize is that cash is not the safe haven most people think it is during a period like this. Yes, cash protects you from a market crash in the very short term, but it does not protect you from the slow erosion that is coming. Holding a reasonable amount of cash for emergencies makes sense. Everyone needs a cushion, but holding the majority of your long-term savings in cash while this kind of money creation is happening is a decision that quietly costs you every single month. The second thing to understand is diversification, real diversification, not just owning 10 different tech stocks and calling it a diversified portfolio. I've spent my career emphasizing balance across different kinds of assets that perform well in different economic environments, some that do well when growth is strong, some that do well when inflation rises, some that hold their value when confidence in currencies wavers. Gold has played that role for thousands of years, not because it is exciting, but because it cannot be printed by any government, no matter how much debt they are carrying. Real assets, productive businesses, and yes, a portion in inflation-protected instruments. These are the things that tend to hold up when the money supply expands rapidly. The third thing, and I cannot stress this enough, is do not try to time this perfectly. Nobody, including me, can tell you the exact week asset prices will move. What I can tell you with real confidence is the direction of the mechanism, and positioning yourself in that direction ahead of time is far more reliable than trying to catch the exact moment. And the fourth thing, which people underestimate constantly, is your own income and your own skills. So in every one of these cycles, the people who did best were not only the ones with the right portfolio, They were also the ones who kept investing in their own ability to earn, because a currency losing value matters less if your income and your skills keep growing in real terms alongside it. Your portfolio is one leg of the table. Your earning power is another. You need both standing if you want the whole thing to hold steady. And there is a fifth thing, one people almost always skip past because it feels too simple to matter, and that is time horizon. If you know you will need a specific sum of money in the next year or two, that money should stay conservative and liquid, because you cannot afford volatility on a short runway. But if you are looking 10, 20, 30 years down the road, you can afford to let real assets do their work through the ups and downs, because over long stretches of history, hard assets and productive ownership have consistently outrun currency debasement, even though the road getting there is never a straight line. I also want to address something directly, because I know some of you watching this are thinking, well, this all sounds inevitable. So what is even the point of trying to prepare? That kind of thinking is exactly how people end up on the losing side of these cycles. The people who come through these periods, the strongest, are never the ones who panicked and dumped everything, and they are never the ones who did nothing at all. They are the people who made a few calm, deliberate adjustments early, before the crowd understood what was happening, and then let time and the mechanics of the system do the rest of the work for them. This is not about becoming a trader or checking your portfolio every hour. It is about making a handful of sensible decisions now, while there is still time to make them calmly rather than in a panic. 3 months from now, when your grocery bill has jumped and everyone online is suddenly talking about inflation again, like it is breaking news, there is one more piece of this that I think deserves your attention, and it has to do with confidence itself. Money only works because people believe in it. The moment a government starts creating large amounts of new currency to solve its own debt problems, it is making an implicit bet that the world will keep believing in that currency anyway. Most of the time, in the short run, that bet pays off, because there is no perfect alternative and habits are powerful. But if this pattern repeats often enough, and I want to be honest with you, it has been repeating with increasing frequency over the last 20 years. Eventually, it changes how the rest of the world thinks about holding that currency as their primary store of value. We are already seeing early signs of this. Central banks around the world quietly increasing their gold reserves at the fastest pace in decades. Some countries exploring trading in currencies other than the dollar for certain transactions. None of this means collapse is coming tomorrow. It does not work that way. And anyone telling you it is going to zero next month is selling you fear, not understanding. But it does mean the ground is shifting slowly, the way it always has throughout history, empire by empire, cycle by cycle. And the people who notice these shifts early are the ones who end up protected when the shift finally becomes obvious to everyone else. So here is what I want you to take away from all of this. In the coming weeks, the mechanics of government debt are going to force a fresh wave of money creation into this financial system. And that money is going to flow into assets long before it ever shows up as headline inflation on the news. The people with the most access to information are already positioning for it quietly through their own trades. You do not need inside access to protect yourself. You need to understand the mechanism. And now you do, Do not let your savings sit passively in cash while this unfolds. Take a real look at your own portfolio this week, not next month, this week, and ask yourself honestly whether it is built to survive a period of currency debasement or whether it is built for a world that no longer exists. This is not about fear, and it is never about fear when I talk about these things. It is about clarity, seeing the machine for what it actually is, rather than reacting to whatever headline happens to trend on a given afternoon. If you found this valuable, and I believe you did because this is the kind of thing that actually protects your family's future, share it with one person who still keeps everything in a savings account and calls it safe. Subscribe if you have not already, because I am going to keep tracking this as it develops, and I do not want you finding out about the next move after everyone else already has. Take care of your money like it is something worth protecting, because right now, more than most moments in recent history, it truly is.